In this lesson, we're going to consider bond markets and how bonds are priced in bond markets. Bond markets are an example of financial markets, which also include equity markets and markets for foreign exchange and a lot of other financial instruments. But we're going to focus on bond markets at this point. When you think about financial markets, you want to think of a couple different kinds of financial capital, if you like. One is debt, the other is equity, two basic types to keep track of. Debt is a simple promise to pay interest and principal in the future. You borrow some money and you promise to pay it back with interest later. Examples of this kind of debt are corporate bonds and government bonds. A business may issue some debt, issue a bond, in order to get some money to buy equipment or to expand the firm. It's a promise to pay back in the future, some principal and some interest in the meantime. Similarly, governments, the United States government will borrow money, and it borrows money by issuing these bonds, which people buy, and the government agrees to pay back the principal in the future. Mortgages are another example. When people buy a house, they borrow the money through an instrument called a mortgage. So that's all examples of debt. Another kind of financial capital is equity. Equity includes corporate stock, the stock of Hewlett-Packard or General Motors or whatever it happens to be. Equity means that there's going to be a payment of dividends to the holder of the equity, to the holder of the common stock, and that payment of dividends depends on the firm's profit. So if the firm is going to be profitable, it can pay out more out in dividends. If it's less profitable, less out in dividends. And the equity is really a right or a contract in which if you're holding that equity, if you're holding that common stock, you have a right to the dividends. Dividends aren't guaranteed. If the firm is not making any money, it'll eventually stop paying out dividends. So there's different types of interest in the case of different types of payments. In the case of debt, the interest is promised, the principal is promised. In the case of equity, dividends depends on what happens to the firm. Now both stocks and bonds, both this debt and equity, are traded on stock markets or bond markets in New York, other financial capitals around the world. And so what we want to do here is study what determines the price of those stocks, the price of those bonds, after they're issued by the government or a firm. And as we indicated, we're going to start with bonds. First of all, what is a bond? Well, a bond is just a piece of paper. I'll hold one up if you want to see it. It's just on the screen again. It's just a promise to pay whoever's holding the bonds a certain amount of money in the future. Simplest would be you pay $100 in the future. In this particular example, it's a promise to pay $100 in the year 2112. So that's 99 years away from the year 2013. So this would be a 99-year bond. And it's very simple. You don't get any payments all those years, except in the 99th year you get $100. So again, it's a piece of paper, and it would be produced and issued. If I would issue it and try to sell it, if I wanted to get some money to do some building or whatever I want to do with the money, I would issue this. And once it's issued, once someone buys it, it's out there in the market and people can trade it. So what we want to example is what we want to study is how much would people be willing to pay for this piece of paper. Guaranteed to get $100 in the year 2112 unless something happens to whoever issues it. Now, to think about this clearly, let's just consider kind of a multiple choice question. If the interest rate you can get elsewhere, say put your money in a bank, is 5%, what is the most you would be willing to pay for this promise, for this bond now? What would you be willing to pay if the interest rate out there, alternative interest rate, say put your money in a bank, is 5%. There's some options here, $10, $2, 80 cents. So you think about it, maybe write down what you think the answer is on the piece of paper, and we'll come back and examine it after we examine what actually are the factors that determine the price of a bond like this piece of paper. Let's introduce some terminology to get into this. First of all, there's the idea of coupon. A coupon is the amount that's paid each year on the bond. It could be $5 a year for several years. The maturity date is when the bond stops, when it's over, when you pay the principal back, pay the $100 back in my example of the 2112. 2112 would be the maturity date of that particular 99-year bond. The face value is how much you pay back, so it would be $100 in the example of the piece of paper I just held up. You have the market price. That's what people are willing to pay for that bond out there in the marketplace when they trade it. The rate of return is very specifically the coupon on the bond plus any capital gain that you get from holding the bond, and it could be a loss if the price falls, capital gain if the price rises, capital loss if the price falls. And that coupon plus capital gain is measured as a percent of the price of the bond, and that's the definition of the rate of return. It's a percentage usually, because you can see the coupon plus capital gain as a percent of the price. And then finally, the yield. Yield is defined as the annual rate of return if you hold this bond to maturity. Okay, so there's a lot of terminology, and you got to think about it as we go through. Probably most important in terms of what we just did is the coupon payment for that 99-year bond, if you remember, was zero, because all that 99-year bond did was pay out $100 at the end. So the face value was 100, the maturity date 2012. There's no coupon, so people would call this a zero coupon bond. And we want to think about what the market price would this be, thinking about both the rate of return and the yield. So let's get started with this. Maybe start with an example of how this works in the marketplace. This is an example of a bond which was issued way back in 1991. It's a 30-year bond, so it's going to mature in 2021, November to be specific. So if you look carefully at this chart here, you'll see 3 dates in which the bond is priced. One date is in 1993, another date is in 1997, and the third date, which is down at the bottom, is October 22nd of this year, of 2013. So there's 3 different dates, and the ones at the top, 91, 93, and 97, are printed out from the Wall Street Journal at that time. The one at the bottom is now coming from the Wall Street Journal's website. Modern technology, it's actually not printed the same way now in 2013. In the middle, I've blown this up so it's a little easier to see, and you can now see the terminology that we have indicated. So you see over on the left, we have something that's called rate. That's the coupon. This bond gets a coupon of $8. $8 is paid to whoever is holding it year after year for the 30 years until it matures. And the 8 is compared to the $100 face value of the bond, which is what's going to be paid back at the end of the period, at the end when maturity occurs. Maturity is labeled November 2021, as I indicated. Then you have the price of the bond, and the price is 2 prices. There's the bid price and the ask price, because these bonds are traded in the market, and there's always people trying to bid for the price, and there's people trying to ask for the price if they're holding the bond. You bid if you're trying to buy the bond, you ask if you're trying to sell the bond, and they're always very close. It's very, very fast-moving, efficient markets, and you can see they're very close in this particular case, both in 1993, 1997, and in 2013. But notice how the prices change. You see $107 there, and then you see $120, and you look most recently at the bottom, $143. So the price of this bond is changing. It makes it a risky investment to hold it, because you might lose if the price goes down, you might gain if the price goes up. The column labeled change is how much the price changed during the day. And then finally, way over on the right, is the yield. That's remember, the rate of return annualized if you hold the bond to maturity. The yield's also changing. You see a 7.3, you see it fall, you see it rise, and we want to understand what's going on. Now, in this particular example, there is an inverse relationship between the price. When the price is relatively high, the yield is relatively low, and vice versa. We want to understand why that's the case. One of the most important things to remember about bond markets and bond pricing is this inverse relationship between the price and the yield. It's true factually, as you can see in this picture. We want to understand why that's the case. So let's get started. I need a little notation to explain how this works. And so let's call the face value of the bond F. Let's call the coupon on the bond R. Let's call the yield little I. And let's call the price P. So we've defined what those are. Now let's go to work and figure out under what circumstances you can calculate the price given you have the face value and the coupon. The economic reasoning here can sometimes be thought of as arbitrage. So often in economics, we analyze a choice by considering just two possibilities. And we're going to do that here too. We're going to compare the rates of return on two similar markets and two similar markets for two different investments. And if there's a difference between those rates of return, investors are going to go quickly to the place where the rate of return is higher. And they're going to get out of the place where the rate of return is lower. So funds will move from one market to the other depending on the rate of return. And because the funds move like this, in equilibrium, the rates of return in the two situations, in the two markets, will be the same. That's what we call by arbitrage reasoning. We're going to look for this equilibrium and where the rates of return in the markets are the same. And that's going to give us our explanation of what determines the price. So here goes. Let's consider the two alternatives and use arbitrage style reasoning. The two alternatives labeled 1 and 2. Let's look at number 2 first. Alternative 1, you can put your money in a bank for a year and you get an interest rate at the bank of 5%, 0.05. Okay, that's pretty straightforward. You put $100 into the bank, you get $5 paid back, and of course you get your money back when you withdraw it from the bank in a year. So that's what that investment's like. The alternative is to buy a bond. The bond has 1-year maturity, the face value is $100, and the coupon is $5. So at the end of 1 year, you'll get your $100 back, and you'll get $5 in addition, $105. So what determines the price of this bond over on the left? How much would you pay for this bond, given that your alternative was to put your money in the bank at 5%? Well, you want to get the rate of return to be the same. The rate of return over on the right is 5%. You want to get the rate of return on the left to be 5% in option 1, but that's going to depend on how much you pay for it. So the price has to be just so much that you get this 5% return on the bond. So think about it this way. Over on the right, we know the rate of return is 5%, 0.05. That's the bank account. Over on the left, we've written down the rate of return as it's defined. It's the coupon plus the capital gain. Coupon is 5. The capital gain is 100 minus what you pay for it, P, divided by P, divided by what you pay for it. That's the rate of return by definition. Remember, it's the coupon plus the capital gain divided by the price. So what you want to do is get the price that just makes that expression on the left equal to 0.05. It's a matter of algebra. There's the algebra. Over on the left, we just take this and solve for P as indicated from step 1, step 2, 105 equals 1.05 times the price, so the price must equal 100. So what we've done, we found the price that simply solves, as shown here in the picture, shown on the left side of the picture, it solves to get you this 5% rate of return, and the price is 100. So there's the price. That's our prediction. You should pay, if this is arbitrage going on, you should be willing to pay $100 for that bond. What if the interest rate at the bank changes? We want to see what might happen to the price. Let's do that. Suppose, to start off over on the left-hand column, that the interest rate goes from 5% to 10%. The interest rate changes at the bank from 5% to 10%. We want to make sure those rates of return are equal. So what happens to the price of the bond? Well, now you have to have the rate of return is equal to 0.10. So that means 5 plus 100 minus the price divided by the price. It's got to equal to 0.1. It goes through the same exercise, and you find that the price, 105 divided by 1.1, is going to equal 95. So that higher interest rate at the bank, it's gone from 5 to 10, has resulted in a drop in the price of the bond from 100 to 95. The intuitive reason for that is the bond has to give a rate of return just like the bank. The bank's now getting 10%. To get it on the bond, you've got a capital gain of 5% from 95 to 100 when you sell it, plus you get your 5% coupon, so you're getting $10 from buying that bond if you buy it at $95. If you bought it at 100, you'd only get $5 back. That would be less than 10% return. So the 95 is just right. And notice that as the interest rate's gone up, the price has gone down. That's that inverse relationship we're referring to. Over on the right, it's exactly the same story in reverse. Now the cases where the interest rate has gone from 5% to 3%. You want to have now your rate of return on the bond equal to 3%. That's what arbitrage is going to give you. The rates of return in these two situations are the same, 3%. Go through and solve the equation for P. And it's going to be 102. So in this case, as the interest rate fell from 5 to 3, the price of the bond went from 100 to 102. It rose. Again, that inverse relationship. And now you can think about it this way: as the bond has a coupon of 5, at the bank you're just going to get $3 on your 100. And so to equalize, there's going to be a little capital loss on your bond. And that capital loss is as the price goes from 102, which you'll buy it at, to 100, which is you get back at the end. So you get your 5 in coupon, you subtract 2 in loss, that gives you your 3. And so you can see the intuition of what's going on in the market to generate this. In general, we can think of this as a little formula where we now have just summarized what we've just done. We got the coupon, we got the face value, R and F, subtract out the P to get the capital gain, divided by P. That has got to equal the interest rate, or what we'll call the yield, the rate of return on this bond until its maturity. Solve this equation for P, and you can see P is inversely related to the yield, or to the interest rate, shown in red just to make it clear. The coupon rate R and the face value F are fixed. That's part of the contract. But if the interest rate should jump up in the market, the price will go down. If the interest rate goes down in the market, the price will go up. So that's all there is to it. It's algebra, but it's also this, more importantly, affect the intuition. In general, for longer maturity bonds, the same kind of thing happens. And we can just refer to the same kind of equations to come away from this lesson with that idea. So if it were 2-year bonds, you just generalize that equation for the price, and now you take the coupon R divided by 1 plus the yield, the coupon plus the face, R plus F, divided by 1 plus the yield squared, and you get the price. If it were N-year bonds, you do the same thing, just continuing it out, squaring what's in the denominator, and at the end you get at the last term there, you get the face value plus the coupon, you divide that plus 1 plus I to the end. So the rationale is just as indicated in the simple example. You just have to worry about the fact there's multi-years. It's of interest to note that the 0 coupon bond is with all the R's equal to 0, and if you set all the R's equal to 0 in your bond equation, you get the price as simply the face value divided by 1 plus I raised to the nth power. And so that's going to give you a way to compute the price of the 0 coupon bond I started with. And so let's finish off to think about this question which we started at the beginning based on the analysis that we've done. What should be the price? What about the price on this 99-year 0 coupon bond that I started this discussion with? What would you be willing to pay? What would the price likely be in the market? And remember, we put in that question that the interest rate was 5%. So all you need to do now is use that formula, which we got the intuition for. It says the price should equal the face value 100 of 100 divided by 1 plus I to the 99th power. If the interest rate I is 5%, which was what the supposition was in that original question, you should be willing to pay 80 cents, only 80 cents for that 0 coupon bond that gives you 100 at the end. And that's an example of how you do the computation. Come away from this by recognizing there's this inverse relationship between interest rate and price, between yield and price. Think about the algebra underlying that as demonstrated in this example here. But most important, think about the intuition of what's going on in the market. Thank you.